Today, we are going to talk about 3 big mistakes every retiree makes with their 401k plan. Now then, mistake number 1
is not knowing the RMD rules, which is required minimum distribution.
Once you turn 72, if you're either an owner or no longer working, the IRS requires you to start withdrawing a certain amount from your 401k each and every year. Missing an RMD can lead to a
50%
penalty tax. Yes.
Very expensive.
Ow. And can also maybe cause some problems for the plan sponsor and everybody else. If you are not an owner and you're 84 years old, in other words, over 72, then you are not subject to RMD.
If you're still working.
If you're still working, yes. Defined benefit plans follow almost all the same rules as a 401k plan, with the exception of the fact that once you're taking your RMD, you're technically in pay status, okay? And unless you're earning a larger accrued benefit, your RMD for your DB plan is the same amount every year, all right? You're basically taking your annualized amount from the DB plan, all right? Whereas with a 401k plan, because the account balance goes up and down as the market changes and as you take money out of it, you're usually taking a different amount out every year. So mistake number 2, insufficient withholding. Because an RMD is not eligible for rollover, it is not subject to the mandatory 20% withholding, but it is still
subject to tax as income.
It is still income, all right? So if you've taken out your RMD and you haven't had any withholding taken out of it, the following April when you go to pay your taxes, you might have a surprise, all right? So think about the math. If you're in and I'm just making up tax brackets, okay? If you're in the 30% tax bracket and you've taken a 20% withholding already, mandatory withholding, have you paid all your taxes, Katherine?
Nope. There's a gap.
Yeah, there's a gap. So think of the 20% as a prepay. You're prepaying your taxes. Katherine likes to call it a marker. I like to call it prepay, okay? If you happen to be in the 18% tax bracket, have you paid all your taxes?
You've overpaid.
Well, you've prepaid a little bit more. You might have other taxes due somewhere else, okay? So, but yeah, you don't owe any more tax on that distribution, all right? So please make sure that you understand what your potential tax liability is when you decide how much or how little withholding to sign up for. Mistake number 3, taking money out of your plan early. If you withdraw your funds from your retirement plan before age 59.5, you will generally owe an additional 10% excise tax on the amount you take out, unless of course you're rolling it over to an IRA. Now then, this premature withdrawal penalty is on top of whatever tax you owe, okay? So let's say, now what you have to understand is that the 10% excise tax penalty does not reduce your taxable amount, all right? So let's say you're taking out $100,000 from your 401k plan before age 59.5, and you have your 10% excise tax penalty. That 10% on $100,000 is 10 grand, but what is your taxable income amount still?
$100,000.
On $100,000, okay? So a lot of people think—
it's called a bigger haircut.
Yes, a lot of people think, well, I paid this 10 grand, so now my taxable amount is only 90. Nope, that's not how excise taxes work, all right? So you're still going to have to remember that on top of the $100,000 going towards your income, you're also going to have a $10,000 excise tax penalty that is not offset by anything else. It's based on the distribution amount alone. You don't get to offset an excise tax. Hopefully you've enjoyed this video as much as we have. So if you like this one, please go and watch some of our other 401k videos that are here. Thank you very much for watching. Like, subscribe, let us know what's going on. Tell your friends and neighbors about us. Tell people you don't like about us so that they have to watch us. We don't care. We just want the interaction. And remember, keep those cards and letters coming.
Toodaloo.